take a big step back and look at it, it's really a process. And I think each of the steps is kind of equally important. First of all, you really kind of want to consider your own experience and feelings about risk. I think at this point, most people have had some sort of market-based investment at some point in their life or some exposure to it. So I think a real kind of hard, honest look at yourself and a genuine assessment of what's acceptable and what causes excess stress is really kind of, just a very beginning point overall. If even modest market fluctuations make you nervous, you're probably not the type of person that needs to be invested in a very aggressive portfolio, because I don't think it's something you're going to be comfortable sticking with in the long term. But there's some really good data points out there that will kind of educate you on what risk really looks like and what different types of investing really look like. And I think that's part of it too, saying, hey, what do we mean by risk, right? What does this really look like? If I'm moderate, what does that mean? If I'm conservative, what does that mean? If I'm aggressive, what does that mean? I think that's a huge part of it, is to understand, what are we talking about when we define things as moderate, aggressive, or conservative? I think understanding what risk really is the most important. The assessment really isn't so much about the upside, which is where I think people kind of lose focus in really good markets. A super important part, and this is where a lot of really good perspective comes into play for clients over time, is defining what your short and long-term goals really are, right? So if you're talking about, a pool of funds, perhaps, you've got a 5 or 6 or 7 year plan. Hey, at a certain point, I want to save up enough money and I want to buy a house. That pool of money that you're working on to do that is going to look very different in investment terms than I'm 35 years old and I've got a 401k and I'm going to work till I'm in my late 60s or 70 because that's what I want to do. Those are two extremely different pools of money, and they will have and should have very, very, very different risk profiles. So understanding A, what does risk look like, and B, what do these long and short-term goals sort of define in terms of what your risk profile ought to look like, I think is absolutely huge. So having a plan and goals and a focus on the longer term, I think creates a lot of perspective on that once you understand what risk really looks like. And I think equally important also, to kind of keep the process working, you need, kind of a disciplined approach to what your portfolio composition looks like. It's not good enough to just say, hey, well, I've defined myself as moderate, and I've defined the right pool of money for my moderate investment strategy. I'm going to set it and forget it. It's not how the world works. One of the things that you see a lot is when you've got a long, good run in the market, right? A bull market condition, a couple years of positive returns. If you don't make any changes to your portfolio, maybe you started with a 60% equity model, 40% fixed income. After a bull run, you might be 80% equity or 85% equity. That has a very different risk profile than your original 60-40 model does. So if you don't put the work into understanding the goals for the money and doing some systematic and periodic rebalancing with those investment funds, you're going to find yourself sometimes unwittingly in a very different risk profile than you started with.